Hello, and thank you for joining us today for the Federal Home Loan Bank of San Francisco's Affordable Housing Program General Fund Application webinar for rental projects. We'll be going over the 2025 AHP General Fund rental application today. My name is Brandon Chan, and I'll be one of your presenters today. My colleagues Brandon Walker and Samantha Stallmeyer will also be presenting. This is our schedule for today. During this webinar, we will provide an overview of the bank and the Affordable Housing Program's General Fund. We'll then go over the changes for this upcoming round. We'll also give you some insights into how we score applications and how we review the financials for need for subsidy and feasibility. And we will end with a Q&A session. During the webinar, you will be able to submit written questions to us at any point during the Q&A dialog box. We will provide written answers throughout the webinar and answer any remaining questions live during the Q&A session at the end. Please do not put questions in the chat. Included in yesterday's email to all webinar registrants were links to our application package that includes several helpful documents that we will reference throughout today's presentation. Hopefully you downloaded that and have a copy of the application, the rental workbook, and scoring results from the last competition. In the resources section of Zoom, you can also find a PDF of today's PowerPoint presentation for download. Before we begin reviewing the application, I would like to talk a little about the bank and the Affordable Housing Program, or AHP General Fund. For those of you who aren't familiar with the Federal Home Loan Bank of San Francisco, we are a government-sponsored enterprise and a cooperative made up of member financial institutions that include commercial banks, credit unions, industrial loan companies, saving institutions, insurance companies, and community development financial institutions chartered in Arizona, California, and Nevada. The bank's mission is to enable families and households of all income levels to obtain quality housing and home ownership. First, the bank provides low-cost funding and other services that help member financial institutions make home mortgages and provide credit to people, neighborhoods, and communities. And secondly, the bank funds community investment programs that help members create affordable housing and promote community economic development. The Affordable Housing Program is the bank's largest community investment program. Since 1990, the bank has set aside 10% of its annual net income to support the program. The bank has awarded over $1.35 billion in AHP subsidies to produce over 156,500 units of quality affordable housing targeted to low and moderate income households. AHP grants are awarded through a competitive application process. The bank's members' financial institutions, working in partnership with community-based housing sponsors or developers, submit applications for specific projects and programs. In addition, the bank has specific down payment assistance programs, as well as an economic and community development grant program. In 2023, we also added a targeted fund that is specifically for Nevada projects. That fund is very similar to the general fund, but is covered in a different webinar. If you'd like to know more about the Nevada Targeted Fund, reach out to one of the contacts listed at the end. Just to let everyone know, in the 2024 General Fund competition, the bank gave away over $52 million. We received 121 applications and 50 received an award, which makes an approval rate of 41%. The bank's earnings in 2024 were not as strong as 2023, so we will have less money available for this upcoming competition. Although this webinar is focused on completing the application, we think it is helpful to give a brief overview of the AHP process. The application must be submitted in partnership between a sponsor and member. There is only one competition per year, and the upcoming 2025 application deadline is Tuesday, March 4th at 5 p.m. Pacific Standard Time. Be aware that there is also critical earlier deadline. Applicants must request a workspace in our secure portal for each project they would like to submit. The deadline for submitting a workspace request is Tuesday, February 25th at 5 p.m. Pacific Standard Time. If you miss this deadline and do not request a workspace by February 25th, you will not be able to apply. The award announcements will be made in late June. Once an award is approved, both the sponsor and member must attend a compliance webinar prior to requesting the disbursement of the funds. Attendance at a compliance webinar is valid for 2 years. Note that the compliance webinar is different than this application webinar, and our next one will be held in July. Once a project has all permanent sources of financing secured, construction is imminent, and the sponsor and member have attended a compliance webinar, the sponsor and member can request disbursement of the AHP funds. Every 6 months until project completion, members and sponsors must complete a project progress report called a semi-annual survey. Awardees must complete construction and draw down and expend the AHP funds within 4 years of award approval. A project must show reasonable progress towards completion to maintain the AHP subsidy. Once construction is complete and the HP funds have been funded, the bank will conduct compliance monitoring called initial monitoring to confirm that the project fulfilled the commitments made in its original application. A request for initial monitoring documentation will be sent 6 to 18 months after the project is complete. Upon project completion, the income retention and compliance period for rental projects will be in place for 15 years, during which the project must continue to meet its original scoring and affordability commitments. Please make sure to refer to our policy updates located under the AHP section on our website, as they provide important policy guidance for the AHP process. Next, we'll go over some basic program information. The AHP is a source of gap financing for rental projects, and maximum award amount for a project remains $2 million for a 2025 AHP funding round. Because members and sponsors apply together, they are partners throughout the life of the award. If you are really struggling to find a member to partner with, we can help you put you in touch with a member bank in your area. However, it is usually easiest to partner with an organization you already have a relationship with. A complete list of our members can be found on our website. If you need help finding a member bank for your project, please reach out to us offline. The HP award is a subsidy structured in the form of a forgivable loan secured for 15 years by the member in the form of a promissory note and deed of trust. The AHP can only be used to assist those households at or below 80% AMI, and the program is structured in a way that rental and homeownership projects compete together, meaning that there is no specific set aside for either project type. The AHP can be used to cover acquisition, construction, or rehabilitation costs for rental or owner-occupied projects. AHP awarded projects are required to fulfill scoring commitments. If there are project changes after the award is made that affect scoring, a modification must be requested. A project must demonstrate a financing gap and that it will be financially feasible at all phases. If the project receives AHP funding, it must continue to demonstrate a gap at the time of disbursement and at the time of compliance monitoring. Again, a project has 4 years to utilize the HP funds and complete construction. The bank will review the project status twice a year and follow up directly with projects that do not demonstrate reasonable progress or the ability to finish in 4 years. Projects awarded AHP funding must comply with fair housing and affirmative marketing requirements. Projects that are already complete, as in those with a temporary or final certificate of occupancy or notice of completion at the time of the application deadline, are ineligible to apply for AHP. For projects that already have an existing AHP award that need additional funds, you can only resubmit an application to request additional funding if you first canceled the original award. Previously, a member could only request up to $15 million in each general or targeted fund round. We are getting rid of this cap for the 2025 round to make it easier for sponsors to find a member after many of our largest HP members have shifted their membership to other Federal Home Loan banks. For nonprofit sponsorship scoring, the Emerging Minority Owned Business Enterprise (MBE) and Women Owned Business Enterprise (WBE) developers subcategory has been revised to clarify which type of organizations qualify for points. We added that the sponsor's organization's primary focus must be to develop, operate, and/or provide services for affordable housing, and also that the sponsor is not any kind of government agency, since those organizations are not emerging in the same way a smaller developer would be. Note that tribal agencies or housing authorities can still qualify for points here. For housing for homeless households, we updated our guidance to clarify that households at risk of homelessness are eligible to receive points for tribal projects. We have also changed our implementation plan so that the AHP homeless definition applies regardless of the project award year. For our empowerment scoring category, we have extended the timeframe for documentation to allow execution within 1 year prior to the application, replacing the previous 6-month requirement. Our community stability subcategory, revitalizing neighborhoods by optimizing project site use or preserving affordable housing, has been amended to reflect the following changes. We've updated our definition of infill to align with California's Infill Infrastructure Grant Program, which allows previously developed infill sites to receive points, which will hopefully reduce confusion about what qualifies in this area. Documentation requirements for adaptive reuse projects have been updated to include the submission of either photos or other documentation instead of requiring both. For substantial rehabilitation points, we will now base these on a project's hard cost per unit, at least $25,000, replacing the previous requirement for a capital needs assessment. This is in better alignment with the tax credit allocation agency in all three of our district states. We will also be removing the demolition of substandard building points. This category could be difficult to document on some projects, especially when demolition has occurred many years earlier on multi-phases projects. Projects that would have been eligible to receive points in this area will instead be able to receive points on the development on an infill site point criteria after the revised definition of infill noted above. Moving on to our in-district scoring category. This criteria has been increased from 5 to 8 points to create tier scoring based on state. California and Nevada projects will still receive 5 points, and Arizona projects will now receive 8 points. For our project readiness category, scoring has been reduced from 7 to 6 to offset the in-district increase. This was done through reducing full site control from 3.5 to 3 points and building permit issuance from 3.5 to 3 points. Additionally, for California projects, a California Excess Sites Program lease option agreement has also been added as an option to achieve full site control. Our native housing category has expanded the definition of a tribal government to include tribes awarding federal recognition and also tribes who have also had their tribal status revoked by the Rancheria Act of 1958. For our subsidy per unit category, adjustments have been made to increase the minimum and maximum subsidy per unit for both owner and rental projects, allowing smaller projects to request more funding without losing points. In the general fund, this category has also been reduced from 5 to 3 points to allow for the increase in in-district scoring. And the new range for rental projects is $30,000 per unit to receive the maximum points in the category, declining to receiving 0 points for asking for 65,000 or more per unit. Looking at feasibility updates for this round, we have some changes that everyone should be pretty excited about. We received new guidance from our regulator that is allowing us to both include resident services in the project's operating budget as an expense instead of having to show them below the line. And we are also no longer required to review a project's cash flow when determining its need for the AHP subsidy. This means we can also get rid of our 3 cash flow related benchmarks. Here are a few things to keep in mind while filling out the application form. The application automatically adjusts based on the characteristics of your project. Progress in refilling out the application is tracked at the top of the workbook and in each section. Applicants can easily jump between sections through hyperlinks within the document. Through icons next to each data field, the form will also tell applicants what information is required and if each section is completed correctly. Make sure to read the instructions for each section and understand the scoring category requirements. Don't forget to reference and upload backup documentation if required for a scoring category. Too often, points are not awarded because documentation was not provided. Unfortunately, we cannot contact you during the round to ask for missing documentation. Address all errors or warning messages. The application form is intended to help you get the right information in the right data format for us to score your application. Data fields with error messages will not be scored. Make sure that the information is consistent. For example, the targeting in the application should match the targeting in the financial worksheets. Inconsistent information may result in loss of points. Make sure that your application is 100% filled out before you upload your final version. This will be noted by the progress bar at the top of the worksheet. Almost all the questions require an affirmative or negative response, even if the question doesn't apply to your project. Remember that it is best to fill out the application questions sequentially to avoid formula errors. There are maximum character limits for some text boxes on the application. The text boxes should have enough space for the appropriate responses. However, if you have more to write, you can upload separate additional documents. The application provides an estimated score to be used as a reference only. However, just to note, the bank will make the final determination in the awarding of points. The interpretation and implementation of scoring criteria is at the bank's sole discretion. Application documents must be submitted electronically through our secure online portal. To get started, the member and sponsor must complete and submit a request for a project-specific workspace folder on the secure portal for each application by 5 p.m. on Tuesday, February 25th, 2025. If you do not have a workspace, you will not be able to apply. For each application, the member and sponsor can authorize up to 5 employees to submit documents to the secure portal workspace. We will notify the designated member and sponsor representatives via email to complete authentication to get access for each workspace. The portal users will have to click on the link in the email and follow the instructions. Members are strongly encouraged to review all complete application materials and documentation prior to submittal. Keep the application form and financial workbooks as Excel files in the appropriate format. Some things to keep in mind when uploading documents. Make sure the documents that need signature have a signature. We do allow for DocuSign signatures as well. Do not rename, move, or delete the folders. This can cause us not to receive your documents, which could jeopardize your project score. Do not restore files from the workspace recycle bin, as this can also cause errors. If you re-upload updated documents to the same folder, it will overwrite the existing one. Do not submit documents without redacting personal identifiable information such as SSN, driver's license number, or bank account numbers. Do not upload encrypted documents because they cannot be imported into our system. Make sure that everything you upload by Tuesday, March 4th is what you intend to submit. You will not be able to upload anything after the deadline. Note that there is no submit button in the portal. Whatever is uploaded in your workspace on the deadline is your final application package. Lastly, make sure that the secure online portal website is not blocked by your IT department or have them unblock it so you can access the workspace. Here is an example of what a workspace looks like. When you're uploading files you'll also want to make sure that there's only one PDF per folder as shown on the right. Technically, you can upload a bunch of documents to the folder as shown on the left, but since there's only one file that can be accepted into our system, you'll want to make sure you combine those multiple files into one. If you upload multiple documents, it is likely they will not be received and reviewed by our team. You may also lose points in the scoring category and not receive an award. Remember that we cannot contact you during scoring. As we go through the application, this is how the total 100 points for the application are allocated. Most of the categories are straightforward. All categories are self-scorable in the application. It is impossible to get all 100 points since this is an open competitive application with both rental and owner-occupied projects competing side by side. Some questions are only relevant to rental projects while others are only relevant to owner-occupied projects. This keeps the scoring balanced and levels the playing field for both types of projects. As I go through each of the categories, note that there will be categories where all applicants typically get full points or score well, and then there are other categories where not many projects will get points. It's in these categories that a project can have a scoring advantage in the application process. See 2024 scoring results in the materials we provided for the average score of last year's approved projects. Please double check that your submitted documentation is uploaded and clearly shows that your project meets the requirements of the category. If documentation is insufficient, we will not be able to award points. Next, I'll pass it over to Brandon to go over the scoring categories. Feel free to follow along with a copy of the application open in front of you.
Thank you, Brandon. Our first scoring category is targeting. Targeting is worth up to 20 points. It is the largest possible point category for any one category. Rental and owner projects are scored separately. This is an extremely competitive category, meaning most approved applications receive full or near full points. To get the full 20 points in this category, at least 60% of the units must be targeted to households earning 50% or less of the area median income, or AMI. When less than 60% of the units are targeted to households at 50% of AMI, then points are awarded on a declining scale. Projects can also include market rate units. However, there is a minimum threshold to be eligible for AHP. At least 20% of the units must be targeted to 50% AMI households. On the application, you will enter the number of income restricted units and their corresponding AMI levels into the yellow shaded cells in the table. The gray cells will be activated and turn yellow once the number of the units are entered into the cells. We suggest you then enter the number of non-income restricted units after that. The total non-income and income restricted units must equal the total number of units in the project. Be sure to indicate the number of total managers units as well, regardless of whether that unit is income restricted. Make sure to enter only whole numbers with no decimal places or you will get an error. Information in this section must be consistent with the targeting worksheet in the financial workbook. For occupied rental projects, households must be income qualified to meet the AHP targeting commitments at one of 2 points in time. First, upon initial occupancy after completion of acquisition or rehab for projects with an approved relocation plan, or at application for projects without an approved relocation plan. This means that grandfathering in households who were income qualified at move-in date prior to the AHP application is not allowed. For households whose incomes have increased during their tenure at the project and now exceed the unit's original targeting designation, targeting commitments in the AHP application should reflect current household income. For example, the targeting for a unit where the household was income qualified for a 50% AMI unit at move-in in 2015, who is now earning 80% AMI, should be set at 80% AMI, not 50% AMI. In the last competition, the average score for an approved project was 19.84. Donated property is the next category. Points will not be awarded if less than 20% of the project units or land associated with the project meets the category criteria. Points can be prorated if not all units qualified. There are 3 situations that qualify for points. The first is a straight donation. If the site is acquired or to be acquired from an unrelated third party for $1,000 or less, or a long-term land lease is executed for $1,000 or less in total rent payments over the 15 years, then application is eligible for 5 points. If this scenario is relevant to your project, complete the first section titled Donation of Property. The next is acquisition of property from a federal agency. If land is conveyed from a federal agency at a price greater than $1,000, then 1 point will be awarded. If this is the case for your project, complete the middle section. The third way to get points is if land was acquired from an unrelated third party at a significant discount to fair market value. So, for example, if you have a property with a fair market value of $1 million and your purchase price was $200,000 or 20% of the fair market value, you'll receive 1 point. If the purchase price is $150,000 or 15% of the fair market value, you receive 2 points. If the purchase price was $100,000 or 10% of the fair market value, you receive 3 points. If the purchase price is $50,000 or less, or 5% or less of the fair market value, you receive 4 points. If this scenario fits your project, fill out the third section under donated property called acquisition of property below fair market value. For all these situations, the donation or conveyance must be an arm's length transaction. In other words, the sale or transfer of a property from a nonprofit developer to its affiliate would not be eligible for points, nor would the sale of property owned by a co-general partner to the partnership be eligible for points. Donations cannot come with any financial conditions or strings attached, such as a loan or other payment conditions. Transfer of title from your donor to the sponsor does not have to take place prior to submission of the application to receive credit, but you do need to submit documentation to get points. If the property has not yet been donated but will be at a future date, the bank will give credit for legally binding, fully executed purchase contracts, lease agreements, and other options, or an exclusive right to negotiate that includes specific purchase or lease costs. Note that a letter of intent to donate property is not binding and therefore would not be eligible for points. As a reminder, points can be deducted if the transaction does not materialize, and a reduction in points could jeopardize your award. So you want to make sure that the donation is a sure thing when requesting points under this category. For acquisitions at an amount significantly below fair market value, an appraisal must be submitted with the application and must have been completed by an appraiser certified within the state where the project is located. Also, the appraisal valuation date must be within 6 months of the acquisition agreement date. Information on the support documentation should be consistent with the address and APNs included in your application. Make sure there is a clear linkage between the parties in the documentation submitted. Also, make sure the donated or conveyed amount is consistently reflected in the development budget. This is absolutely the link between scoring and the financial review. We do confirm that there are no acquisition costs or that there are just the nominal costs in the budget. If you have a project where the land was initially donated by a third party, but you will be required to show a value in the budget for accounting purposes, please contact us offline to see if this will be acceptable. We will need to see that there is no gain on sale from any subsequent transfers after the initial donation. For properties that were donated or conveyed at a nominal or below market price prior to application, transaction consummation must have occurred within 5 years of the application deadline or start of construction, whichever is earlier. Donation or conveyance at a nominal or below market price must ultimately be documented to maintain points. For projects owned via a long-term lease that are seeking credit for a donation at a nominal value, annual lease payments must sum a total of $1,000 or less over the course of 15-year retention period to receive points. Under the donated or conveyed property section of the application, you must enter the number of units that apply to each situation. If none of the situations apply, you must enter 0. If you think that your project qualifies for these points, see our implementation plan for more details. In the last competition, the average score for the approved rental projects was 1.45. The next category is nonprofit sponsorship, which is worth 9 points. This is an overview of how the 9 points are allocated in this category. In addition to awarding the points themselves, we will be evaluating the project sponsor's roles and responsibilities in the project to make sure that the project sponsor is qualified and active in the development of the project, based on the information included in the sponsor profile section. First, the bank has discretion in determining whether a nonprofit sponsor meets the category and sponsor eligibility threshold requirements. The nonprofit status of an organization is a threshold criterion, and you would be eligible for the remaining points if the 2 statements under the sponsor classification section are true and you are a qualifying organization. The general sponsor eligibility requirements are: if the sponsor has been engaged in the ownership, management, or development of affordable housing for a minimum of 1 year, if the sponsor has sufficient capacity and staff experience to perform project roles and integral responsibilities, if the sponsor has ownership interest in the project, including any leasehold, partnership, or controlling interest through the entire 15-year retention period, if the sponsor is integrally involved in the project responsibilities, such as project planning, project development, construction, property management, and securing development financing or other funding commitments. For not-for-profit organizations or government entities, the project sponsor must be the parent organization and not an affiliate organization. Make sure you are indicating the correct entity in your workspace setup request form and the application. Examples of an affiliate organization that do not generally qualify for project sponsorship include the development affiliate of a nonprofit or housing authority, the project LP, a CHOTO affiliated with the parent organization, an LLC affiliated with the parent organization. Please note that the type of entities that qualify for points are nonprofit organizations, Native American tribes, an Alaskan Native village, or the government entity for Native Hawaiian homelands, a state housing agency, local housing authority, and a state or political subdivision of a state. If the sponsor meets the criteria, then the next 4 points are allocated based on ownership interest in the project. Also, there are regulatory requirements that project sponsors must have an ownership interest in a project for the entire 15-year period. If an entity is working to develop the project but will exit ownership structure after completion, this entity should not be the project sponsor. Up to 4 points are awarded if the nonprofit sponsor entity owns greater than 50% of the project, or if a project is owned by a limited partnership. Points are dependent on the nonprofit sponsor general partners, or GP's, ownership interest. A nonprofit GP with greater than 30% and less than or equal to 50% in ownership interest receives 2 points. If the nonprofit GP has less than or equal to 30% ownership interest, then 0 points are awarded. Be aware that points will not be awarded for commitments that are made contingent on the receipt of AHP funding. Only the ownership percentage that is in place as of the AHP application deadline. In the application, you will need to indicate the limited partnership's interest distribution and the distribution within the GP. If there are two general partners, the nonprofit project sponsor and a nonprofit partner, then we will consider the nonprofit entities as sponsors for the purpose of scoring in the calculation of nonprofit percentage of ownership interest for rental and award the full 4 points. If there are two general partners comprised of the nonprofit sponsor and a for-profit general partner, and they both have 50% voting and ownership interest, then only 2 points are awarded based on a nonprofit entity only having greater than 30% ownership interest. Note that 4 points are awarded only if the ownership interest is greater than 50%, not equal to. The next points are awarded based on a percentage of the total available developer fee received by the nonprofit sponsor, including future investor payouts and or cash flow. The bank does not want the nonprofit sponsor stuck with just the deferred fee. If the nonprofit sponsor receives equal to or greater than 25% of the fee, or if by some chance there is no developer fee, then 3 points are awarded. If the nonprofit sponsor receives less than 25% of the total available developer fee, then 0 points are awarded. If a project is in construction at the time of application and there is a limited partnership agreement or other agreement with the project's investors in place, the ownership interest and developer fee percentage must already be documented by the LPA or by an agreement that is referenced within the LPA to receive points. Otherwise, at disbursement, we will need to see that the LPA or operating agreement or a document referenced therein confirms the ownership interest and developer fee split. Make sure to select the correct response here. If you mark that the project has no developer fee, and we note a developer fee in the budget, then you may not receive the 2 points. As proof of tax-exempt status, a nonprofit organization must submit IRS 501c3 letter or a state franchise tax board letter. The bank does not accept bylaws or articles of incorporation as a substitute for showing tax-exempt status. If there is an entity name change, please submit the updated IRS documentation. If the sponsor is a government or tribal entity, then no documents are required. Please also include the organizational chart of the project's ownership structure with your application. The last nonprofit subcategory is one that awards 2 points to emerging minority or women-owned developers. If the project earns at least 5 points in the preceding subcategories, the project may earn points in this subcategory, meaning the sponsor must have some amount of ownership interest and must receive at least 25% of developer fee in order to receive these points. Emerging minority or women-owned developer points will be awarded to projects that meet all of the following criteria. Similar to last year, the project sponsor must be a minority and or a women-owned developer defined as meeting at least 2 of the 3 following criteria. 1, the project sponsor's CEO or executive director is a minority or a woman. 2, the sponsor's board of directors is greater than 50% composed of minorities or women. 3, the sponsor's senior management, as defined by the organization, is greater than 50% composed of minorities or women. 2, the project sponsor organization must also have fewer than 5 years of development experience or have developed fewer than 5 projects in the last 10 years. For this year, we have also added 2 additional criteria to receive points. The sponsor organization's primary focus must be to develop, operate, and or provide services for affordable housing, and the sponsor cannot be a state or political subdivision of a state housing agency, or local housing authority, with the exception for tribally designated entities. The sponsor must certify that they meet all criteria using the AHP Minority or Women-Owned Developer Form, which is a new attachment for this year that you will see when you download the application package. As noted, this is a new subcategory. We surveyed other emerging developer programs, and while we believe our requirements are aligned with other programs, please let us know if you discover a conflict between this new subcategory and another emerging developer program. In 2024, the average score in this category was 7.36 points. Now, I'll turn it over to Samantha to continue going through the general fund scoring categories.
Thank you, Brandon. The next category is homeless housing. It is a 6-point category, and points are awarded to projects that create transitional housing or reserve and set aside permanent rental units for homeless individuals or households. Be aware that projects are not able to score points in both the housing for homeless households and housing for special needs population scoring categories, so you will need to make a choice if you serve both populations. On the application, please describe the homeless program in the text box provided, including a description of the outreach activities and referral agencies used to reach this population. The AHP regulation requires that the bank provide or set forth a homeless definition in the implementation plan, which we will go over on the next slide. At initial monitoring, we are also required to collect documentation confirming that the homeless status of each individual meets our definition. Be especially careful about making commitments here if you have an occupied building with existing tenants who you think qualify as previously homeless. In addition to making sure they met the definition at move-in, you will also need to provide documentation of their homelessness at move-in, which can be hard to locate for long-time residents. So you want to make sure this documentation is available before you commit. Scoring in this category is slightly different from other unit-based categories, where points are simply prorated based on the number of units reserved. For this category, you get an automatic 3 points if a minimum of 20% of units are reserved for homeless households. The remaining 3 points are prorated based on a ratio of the remaining units that are reserved for homeless households. The bank is trying to encourage projects to reserve units for this population. When we say reserved, we mean that units should be held vacant unless occupied by a household meeting that definition. Additionally, to receive points for homeless housing, there is a minimum stay requirement of 6 months. Transitional housing projects are eligible if they require a minimum of 6 months occupancy and meet the transitional housing definition, which means that 1, the intention is for households to stay for at least 6 months, not just that they could technically stay, which is true of some shelters. And 2, if the project is operational, most households in the transitional units actually do stay for at least 6 months or move into permanent housing within that time. And 3, households also do not need to pack up their belongings and vacate the premises during the day, and they need to have access to supportive services, programs, or other efforts that will help them to transition out of homelessness. That means that overnight shelters often do not qualify for homeless points because of the minimum stay requirement and the thresholds needed to qualify as true transitional housing. Overnight shelter projects can still apply for AHP funds, but would not receive any points under the homeless housing category. If you are developing transitional housing or a shelter project that includes shared rooms, make sure to enter the number of projected households as the number of units in the project. Also, please note that the units listed as reserved here must be consistent with the number of units indicated on the targeting worksheet. On the targeting worksheet, we will look to see if rents are appropriate for the population. Often, we would expect to see a dedicated rental subsidy. If your project is reserving units for homeless households and those units are targeted at greater than 30% of the area median income and there's no dedicated rental assistance for these households, then you also must explain how the project will be feasible for the 15-year AHP compliance period and provide documentation from a homeless service provider that confirms that enough households exist in the target market area that can actually pay the scheduled rents listed for the units reserved for these homeless households. In the 2024 competition, 48% or 24 of 50 approved projects received some number of points here. This slide is the bank's current definition of a homeless individual or family as included in our implementation plan. Make sure that you review this definition carefully if you are requesting points in this category to ensure that all reserve units meet our definition. Unfortunately, for most projects, what does not meet the homeless definition are those at risk of homelessness, such as a person living in an overcrowded condition, living in a hotel or motel not paid by charitable funds, or living in the home of another individual due to economic hardship. Note that the 5th definition of homelessness does allow for at-risk households to meet the definition when their at-risk status is combined with a serious mental illness or emotional disorder. This definition does not apply to most projects as it must be documented with funding guidelines from a government agency that specifically serves this population. This year, we also added a 6th definition that allows projects who also receive points under native housing to get homeless points for households that are considered at risk of homelessness, since this better reflects homelessness in tribal populations. For all the details, please review this scoring category in the implementation plan. The next category is special needs. Up to 5 points are awarded based on the percentage of units reserved for special needs populations, those that fall into the 5 categories listed here. A minimum of 20% of the units must be reserved to get any points, and points will be prorated if not all units apply. For example, if 50% of the units are reserved for one or a combination of these populations, you get 50% of the points. There is no double counting for this category. As you can see from the application, there are multiple categories possible. You will not receive credit for more than one designation for the same unit. More than one of these designations can apply to the same unit, but you will get an error message if the number of units input into the application exceeds the total number of units in the project. As noted previously, you cannot receive points in both this category and homeless housing. Also, please note that in the financial workbook, the units set aside for special needs households must be indicated on the targeting and financing sources worksheet. To get points, they must match what is indicated on the application. In the last round, approximately 32% or 16 of the 50 approved projects received some number of points in this category. Here we have our large units category. Similar to homeless and special needs, at least 20% of total units must have 3 or more bedrooms to qualify for points in this category. For example, if 12 of 45 total project units have 3 or more bedrooms, the calculation would be 12 3 or more bedroom units divided by 45 total project restricted and non-restricted units equals 27%, or 3 points. Units must be consistent on both the application and targeting worksheet in the financial workbook. Last year, 50%, or 25 out of 50 projects, received points in this category. Rural housing is a pretty straightforward category. If at least 20% of the units are in a rural area as deemed by a government agency, then you can receive up to 5 points. Points are prorated in this category. In the application, list or describe the agency designating the area as rural after the number of units are typed in. Rural status can be designated by a state or federal government agency such as the USDA. USDA provides this information on their website under Rural Services. You must submit documentation from the designating entity to support your claim. If this information is not provided, the response is considered incomplete and points will not be awarded. In Arizona, rural areas can be designated by a Native American tribal entity. In the last competition, 18% or 9 out of the 50 approved projects received points in this category. The next category is promotion of empowerment. The purpose of this section is to see how your project will financially or economically empower your residents through programs or services. There are 5 services. Each service is worth 5 points. Review the instructions and the notes following each question in the application. Much of the information we want to see in the submitted documentation is outlined there. You get the full 5 points if you meet the scoring guidelines. If you don't meet the guidelines or threshold, then you get 0 points. There will not be any prorated or partial points given in this category. Be aware that for training and education, the frequency of service must be bi-monthly, every 2 months or equivalent. All services must be of a regular and ongoing nature. Also, all services must be free to all residents except for childcare. Services must be made available within 6 months of the project's placed in service date. Documentation is required at initial monitoring to substantiate the provision of services. Points will not be awarded if supporting documentation is not included with the application. If the project has some units reserved for homeless households, make sure you submit documentation for services targeting that population, but also remember documentation for other non-homeless residents. Some types of services needs to be provided to all residents to receive points. If the sponsor is providing the service themselves, then a detailed service plan must be provided. To get credit for a sponsor-provided service, the organization must have in-house capacity to provide the service with staff that has appropriate knowledge and expertise. Use the organization's letterhead, then date and sign the services plan. If the project sponsor hires or contracts with a third-party service provider, then the documentation must include one of the following documents: a memorandum of understanding between the sponsor and the third-party organization, an executed service contract, or a letter of commitment. These documents must list the services and funds which partnering agencies have agreed to provide. Again, it should include the information indicated under the support documentation statement. Service commitment documents must be dated within 1 year of the application deadline. If you have an MOU that was executed beyond 1 year, but the services detailed in the MOU will still be provided to the project residents, then you can have the partner or service provider submit a current cover letter stating that the MOU is still valid and all indicated services will still be provided. Letters of support are not acceptable documentation for provision of services in the empowerment section because they are not a commitment but are more like references. For example, this includes letters written by people or organizations that support the project sponsor and its work, but are not formalized commitments outlining the provision of services. Also, you must complete the empowerment budget worksheet, which should show annual projected expenses of the service, and you must indicate how the project will pay for these expenses. If this is not filled out, no points will be awarded. This budget is included in the financial workbook, so please fill out this worksheet instead of submitting a separate PDA budget. In the last competition, all awardees received the full points in this category. Next, Brandon will go through the community stability category.
Thank you, Samantha. The community stability category is about determining how your project benefits the community at large and contributes to stabilizing the neighborhood. The category is worth up to 14 points. There are 6 main community stability features with specific elements under each feature that you can select. The specific point allocation for each feature can be found in the scoring guidelines in Attachment B of the bank's implementation plan. No partial points will be given, and you must submit required support documentation for each selected element to receive points. Like the rest of the application, even if some of the questions do not apply to the project, you will have to confirm that the question does not apply to the project. In 2024, the average score for the top 20 approved projects was 10.90, and the overall average score was 10.60. So now let's look at the features a little more closely, and we'll go over how the points are allocated. To receive the maximum 3 points under this feature, your project must involve development on an infill site, adaptive reuse of an existing non-residential building, or substantial rehabilitation. The points will be awarded if you select one of these elements and submit the required documentation. Under development of an infill site, a recent aerial photo of the site showing the outline of the entire site must be provided to receive points. Otherwise, we may have trouble determining the boundaries of the site and could be unable to award points. As noted earlier, this year, we updated the infill definition to align with California's Infill Infrastructure Grant Program, which allows previously developed infill sites to receive points. With this change, projects that would have been previously eligible to receive points under demolition of a substandard building will instead be able to receive points under infill development. For a site to be considered infill development, it must have been previously developed or on a vacant site where at least 50% of its perimeter must adjoin parcels that are already developed with existing urban uses. The photo included in this slide is a great example of documentation for infill points. The photo clearly shows the project site with an outline and all adjacent uses are clearly urban. Documentation requirements for adaptive reuse of non-residential buildings or structures need to clearly show the extent to which the project involves adaptive reuse. This can include photos of or other documentation, as long as they can clearly show the project's previous use. As noted earlier, the qualification criteria for substantial rehabilitation points is now based on the project's hard cost per unit, at least $25,000, replacing the previous requirement for a capital needs assessment. This feature is worth 2 points. To qualify, the bank's community revitalization or economic development plan area form must be signed by appropriate planning official and confirm that the plan meets the required criteria. You must meet the following. As of the application deadline, a government entity has formally adopted a plan to revitalize a defined geographic area containing the proposed site. A standard housing element or general plan is ineligible unless it contains a specific revitalization area where the site will be located. The project proposed in the application would contribute to one or more of the plan's stated goals. A government entity has made or is committed to making specific investments in non-housing infrastructure, amenities, or services beyond developing the proposed project. The project benefits from incentives such as streamlined entitlement process, additional funding, or relaxed design requirements by being inside the boundaries of the plan. Please note that we do not award points to opportunity zones in this subcategory as they do not meet the required plan criteria. Being located near transit and amenities is worth up to 4 points. For the transit element, a project must be located within a third-mile radius of the specific transit stop. Half a point up to a maximum of 2 points will be awarded for each transit service or line. Like the transit component, to receive points under amenities, a project must be located within a third-mile radius of the specific amenities that are appropriate and accessible to the project residents. For example, the project may be located next to an elementary school, but if the population is 100% seniors, no points will be awarded for that amenity. Half a point up to a maximum of 2 points will be awarded for each of the 8 amenities listed. Note that you will not receive more than 1/2 point for each of the categories as shown here in this slide. If there are 3 parks near your development, you will still only receive 1/2 point. Some important things to keep in mind. To receive points under this feature, the transit service or amenity must be in place at the time of application. You will need to provide a screenshot from Google or Walk Score clearly showing the number of transit lines and the project's distance relative to those transit lines. The map must be legible and have a clear scale and legend. Route maps from the transit agency showing the destination of transit lines are also required, though we do not require timetables. Applications with non-contiguous scattered site addresses will need to include multiple maps showing the distance from each property address to each relevant transit line and amenity. Again, the application outlines how the distances to transit and amenities should be measured and the required documentation. No points will be awarded without documentation, or if your documentation has missing information needed to determine distance or destination. Here's a good example of a documentation for number of transit lines near the project. This example clearly shows where the project site is, the distance radius surrounding the project, 1/3 of a mile, and the distinct transit lines that are within that area. It also shows a clear scale and legend from a third party. It is very important for both transit and amenities documentation that the third-party scale and legend is included, as we often see project lose points in this area because the third-party scale was missing. This gives us certainty that the information provided is accurate. Otherwise, we can't tell if it was just created by the applicant. Sustainable development are worth a maximum of 4 points. Points will be awarded for obtaining one of the indicated certification levels. The first level is worth 1 point. The second level is worth 2 points, and the third level is worth 3 points. The fourth level is worth 4 points for LEED or enterprise certified projects with net zero certification. The Nevada Housing Division's Silver State Sustainable Home Certifications is also included as an acceptable certification and will be awarded to 1, 2, or 3 points depending on the level of certification. One important point I would like to emphasize is that you should not overcommit here. If the commitment is not met, this will lead to a future project modification involving a loss of points, which could jeopardize the project's award. Also, be aware that new construction projects are not eligible for points related to an improvement over an existing HERS rating. Scoring credit for this type of certification is limited to only renovations. This feature is worth up to 2 points. 1 point will be given for the creation of homeownership opportunities. Home ownership opportunities are rarely applicable to rental projects unless there is an established home ownership conversion plan, such as lease to own plan. These are rare, but if this applies to your project, documentation of the plan must be included and there must be an enforceable mechanism in place to ensure that the home ownership opportunity is available. 1 point will be given for a project being located in a high resource area. The location of a project needs to be in a high or highest resource area where this designation exists. For example, in California, using the TCAC's Opportunity Area Map as shown on the slide, or to an upper income census tract in areas that do not have this type of designation. California projects must provide a printout of the state's opportunity map. Non-California projects must provide a printout of the project census tract from the website of the Federal Financial Institution Examination Council showing the project's location in an upper income census tract. Do not miss out on points for location in the indicated areas. Even if you are unsure your project is in a low-income census tract area, go to the FFIEC or the California Tax Credit Agency's Opportunity Map website and enter the project's address to confirm. All project units, including scattered site projects, must be in a high or highest resource area or upper income census tract to qualify for points. Note that you may choose to utilize the census tract income designation or resource designation from the high or highest resource maps in effect when the initial site control was obtained up to 7 calendar years prior to the application. If you go this route, make sure to make this intent clear in your evidence of community stability PDF and include site control documentation along with the older maps. Next, we get to our last community stability subcategory for preventing and minimizing household displacement. 1 point will be awarded for no household displacement for a site that is vacant and unoccupied or that the project site is occupied and an acceptable relocation plan is in place. To receive 1 point for no displacement, you must provide a written explanation of the project site's history and confirm why no displacement is taking place. To receive the 1 point for displacement with relocation, you must submit a relocation plan. A relocation plan is only required for residential displacement. If a project involves relocation, then we expect to see the relocation expenses in the budget and an acceptable relocation plan, which we will go into detail about it in the next slide. The implementation plan provides specific requirements for a relocation plan. Again, this is only required for residential displacement. If your project is required to go through a relocation plan process by one of its other funders, this should be fairly straightforward as you can just submit your relocation plan that has been approved by that funder, as noted here. If you do not have a plan approved by federal, state, local government funders, you can write your own plan. But make sure it meets all the points in this slide, including a budget. This applies to temporary relocation within a building, as well as permanent relocation and relocation where households are moved out of the project for a period of time while work is completed. We recognize that not all elements are necessary for all types of relocation. So if an element is not appropriate, include a brief explanation why it is not necessary for your project's relocation plan. That brings us to the end of the community stability, which clearly offers a variety of avenues for your project to receive points. This concludes the community stability category, and I'll pass it back to Brandon to finish out the rest of the scoring categories.
Thank you, Brandon. In the project readiness category, points are awarded to projects that have some measure of site control. 3 points are awarded for full site control where you already own the land or building you are going to develop. Documentation must be submitted as evidence for the different options listed in the application. A final settlement statement, title insurance policy, executed disposition and development agreement, or a title report. 2 points are awarded for partial site control where you have an agreement to purchase the land or building. Documentation must be fully executed and valid and is required for all parcels, and it must clearly show that the project sponsor or partners has site control or that there is a link to the sponsor. Make sure that the addresses and assessor parcel numbers, dates, and signatures are consistent that are included in the documentation, especially if this information is in an exhibit. If you receive points for full site control, then you qualify for points under building permit issuance or building permit readiness. The building permit readiness form must be signed by the building department to receive 3 points, whether you have permits or a permit ready letter. Only the form needs to be signed, and you do not need to attach the actual permits or ready letter itself. For projects on Native American tribal lands, a proxy letter from the tribal council or entity is acceptable in lieu of the building permit readiness form. Just a note here, a new form must be submitted every time the application is submitted. Also, if you only have partial site control, you will not qualify for points for having a building permit readiness letter. For tax credit projects, we are also able to award building permit points if there is a limited partnership agreement that includes the investor as a limited partner, since that confirms construction is underway. On the application, even if some of the questions do not apply to the project, you will have to indicate that 0 number of units apply under this question. In 2024, the average score for an approved project in this category was 5.97. This is a very straightforward category. Points are not prorated, but starting this year, they are tiered. Basically, if your project is in California or Nevada, you will receive 5 points. If your project is in Arizona, you will receive 8 points. If the project is located anywhere else, you will receive 0 points. On the application form, the question is automatically answered based on the project address provided. Last year, all 50 projects were awarded and were in district. Next is our native housing. This category has been designed to support development located on tribal land or developed by tribal entities. Projects where all units meet one or more of the criteria listed on the slide will be eligible for points. The project owner can be a tribal government, an agency of a tribal government, a tribally designated housing entity for the purposes of Native American Housing Assistance and Self-Determination Act, or an entity incorporated created in accordance with tribal law. This is a very easy way to get points in this category. This year, we also expanded who can qualify for a tribal government to include tribes awaiting federal recognition and California tribes who have had their tribal status revoked by the Ranchera Act of 1958. Alternatively, you can get points if the tribal funding is included as a source of funding for the proposed project, such as Indian CDBG, Indian CSBG, Indian Health Service Funds, or NAHASDA funding. The amount of tribal funding included in the sources of funds must be an amount equal to or greater than the lesser of 5% of the project's total development cost, or $100,000. While we haven't gotten a project submitted from Hawaii in a while, you could also receive points if the project is in a Hawaiian homeland housing area. Last year, 1 of 50 other projects received points in this category. The subsidy per unit category has been reduced by 2 points and is now worth 3 points. In our AHP, there isn't a maximum subsidy per unit, but keep in mind each project may request up to a maximum of $2 million. But since this is a competition, you get more points the less subsidy per unit you request. Basically, the score is calculated by taking the amount of subsidy requested divided by the number of income restricted units, those that are restricted to households' earnings at or below 80% of AMI. The scoring for rental and owner projects is different and has been adjusted this year to increase the minimum and maximum subsidy per unit, allowing smaller projects to request more funding without losing points. For rental projects, the range is between $30,000 and $65,000 per unit, with the full 3 points for $30,000 per unit and 0 points for $65,000 per unit. The category is scored when you enter the amount of subsidy requested in the beginning of the application and complete the targeting scoring section. We often get the question, how much should I request? And we encourage applicants to request what the project truly needs to fill the gap. However, you may need to balance what your project needs with what score will make your project most competitive. In 2024, 37 out of 50 projects received the full points in this category. Okay, now that concludes the review of all the scoring categories. For our application score summary, at the bottom of the application e-form is a scoring summary that will generate as you fill out the application. This tool will help you see your estimated score before you submit the application and should help make sure this process is as accurate as possible. You can also use this tool to evaluate how competitive your application will be when comparing your project's estimated score with the scores of the previous year. There is no way to predict what range of scores will be in any given year, but if you aren't even close, you might not want to spend your time on submitting an application. In this next part of the webinar, we will provide information on how we evaluate a project's need for subsidy and feasibility and go over financial worksheets. Not only do applications have to score well, but they must also meet the Federal Home Loan Bank standards to demonstrate that the amount of subsidy requested is truly needed and that the project is also financially feasible. In determining need for subsidy, we look at financials to make sure that the project demonstrates a financing gap. We look at the project's financing structure and development costs, and we look to see that the project sources of funding include the AHP equal their projected development cost. And we also look to see that the AHP is filling the project's financing need and that's not covered by other funding sources, and that the project is only asking for enough AHP to truly fill the gap. Please note that we will continue the same treatment as previous years regarding non-arm's length transactions, Net gains on sale or in a non-arm's length transaction that is not reinvested in the project will be considered excess funds and will be factored into our evaluation of the project's need for subsidy. For financial feasibility, we make sure that there are no remaining finances gap after the AHP is factored in. And we review the 15-year operating performance to make sure that the project is financially feasible throughout the 15-year compliance period, meaning that the cash flow is greater than zero or that there is a sustainable source of subsidy for projected deficits. For financial benchmarks, to help us evaluate need for subsidy and feasibility, we use a set of financial benchmarks that projects must meet. These benchmarks are updated often to try and reflect industry standards. If your project deviates from a benchmark, an explanation must be provided. Please be aware of the note at the bottom of the slide. A project must demonstrate need for subsidy and financial feasibility at application, disbursement, and compliance monitoring. If your project has cost savings or receives additional unexpected equity, this could result in required repayment of the subsidy. There are several factors at play here, so please contact us if you think you may have a need for subsidy issue after you are awarded funds. For rental projects, these are some key points we keep in mind when we look at applications to evaluate the need for AHP subsidy and the financial feasibility of the project. If there are more sources than uses, then some of the AHP funds requested are not needed and it becomes a need for subsidy issue. If there are more uses than sources, then the project is still short funding and is not considered feasible. To be financially feasible, the project's operating performance must show that it has sufficient projected cash flow to cover its projected annual operating expenses and debt service. If there are no operating shortfalls projected in the pro forma, there should be operating subsidies or operating reserves to ensure that the project is operationally feasible. Please provide evidence of those subsidies if they are secured already. We also check that the financials match the story being told in the application's narrative. These expenses indicated in the development budget must be consistent with the project's description and scoring sections. For example, under the community stability scoring section, if the project claims scoring points for mitigating the displacement of previous residents during construction with the relocation plan and compensation, then we expect to see relocation costs listed in the development budget. Lastly, we check if the project has any benchmark deviations, which I'll go into in detail on the next slide. If there are benchmark deviations, we need a detailed explanation for why the project's costs are outside of what we normally see. All deviations will be calculated automatically in the workbook and be highlighted in yellow, except for interest rates, which need to be compared to the rates in the reference guide. Benchmark deviation explanations are no longer required to be quantifiable and can come from project sponsors for most benchmarks. But we do still need enough detail and an explanation to really understand what is going on and to be able to explain to our regulator how we got comfortable with it. As noted, services are now allowed above the line, but we do still have a specific line in the pro forma for them. Our operating cost per unit benchmark still ties to operating expenses without services because we don't have historical operating cost data with services. So make sure not to include services costs in explanations for your operating cost per unit benchmark deviation. For the construction cost per square foot benchmark, site work can be used as part of the benchmark deviation explanation. Environmental remediation and hard cost contingency are not included in the cost per square foot calculation and should not be used for an explanation. Our financial worksheets are intended to accommodate the wide variety of projects that apply for AHP. So here are some key points to keep in mind for certain types of projects that don't fit neatly into the AHP framework. For transitional housing or shelter projects on the targeting worksheet, make sure to list each family as a unit rather than the number of rooms or beds available, when you expect to serve families and not just individuals. For example, a project may have 50 beds available, but the estimate of total households served at one time is only 35. So the number of units in the project should be 35 instead of 50. Make sure to be conservative in your household/unit estimates for transitional projects with the fluctuating number of households. Many scoring areas are tied to number of units, and you want to avoid being in the position of losing points and potentially the award in the future if you end up serving fewer households at one time than expected. Often the feasibility of these projects is based on donations, capital campaign fundraising, or other business revenue. We want these types of projects to demonstrate that they have a reliable history of raising the funds they need for development and have a reliable source of income to cover operational expenses. We consider 3 years to be reliable, so please upload 3 years of audited financial statements to the Evidence of Committed Financing folder if this applies to your project. For mixed-use projects, under the AHP regulations, residential rents cannot support the commercial portion of the property, but commercial rents can cover the residential expenses. Note that even though commercial income can cover residential expenses, the residential portion of the project should not be dependent on commercial income for feasibility. If you have a mixed-use project and the commercial space will be revenue generating, fill out the 15-year commercial operating performance in the workbook. Make sure to answer the 2 questions at the top of the worksheet. On the development budget, there is also a line item at the bottom of the worksheet that indicates the development cost for the commercial space. If your commercial development costs will be broken out separately on the project's final cost certification at completion, the commercial expenses should be shown only in this line item and separated from residential uses. For workbook protocols, couple of things to mention in the financial workbook. Please use the version that comes with the application packet you download. You should see version 5.5 at the top right corner of each worksheet. Essential instructions and notes on completing the financials are included in the workbook on the first tab. We strongly recommend reading the instructions on the first tab prior to completing the workbook. Worksheets should be filled out sequentially, starting on the second tab of the workbook with targeting worksheet. The worksheets are all connected and figures and amounts are automatically pulled into other sections of the workbook. We have password protected the shaded cells so that they can't be altered. You can only enter data into the unshaded cells. Again, review the worksheet so that they are accurate and consistent before submitting them. Please make sure that the sources in the workbook match the source documentation provided. Note that we rarely allow changes to the workbook after it has been submitted. Okay. Now Samantha will review the actual rental worksheets for you.
Thank you, Brandon. The first sheet we'll look at is the Instructions and Notes worksheet. We highly recommend that you review this worksheet while you complete your workbook. It contains a lot of helpful instructions and policy guidelines. Next, we'll look at the targeting worksheet. Please input the AMI levels in this worksheet to calculate the target income for each unit type. The worksheet, see the bottom, calculates the rental income for your project and auto-populates the 15-year operating pro forma. At the lower left-hand corner, you will note that 20% of the units must be targeted to 50% AMI or below. This is a program eligibility requirement. This is also where you would note non-income restricted units and manager units. Be aware that there is a field where you can include non-income restricted special needs units, such as seniors, if appropriate. There is also a similar field for non-income restricted large family units. Enter the annual 50%, very low, AMI income limits adjusted for family size based on the HUD guidelines. If HUD doesn't release the 2025 income limits by the deadline, use the 2024 limits. Make sure appropriate AMI targets are set for the population being served, i.e., lower AMI targets for homeless households. Upload a copy of the HUD income limits page showing the appropriate income limit data for this project. If applicable, indicate which units are reserved for homeless or special needs populations. The number of units reserved must be consistent with the homeless or special needs application scoring categories. Please input whichever category the project is seeking points under, either homeless or special needs, not both, due to the scoring guidelines which prevent double dipping in these categories. The AHP application comparison at the end of the workbook will compare this rent roll to the selections made in the application e-form. Again, for transitional or shelter housing, enter the number of projected households as the number of units and not the number of individuals or beds. Do not input operating subsidies as rental subsidies. there's a specific area where you would input the operating subsidy in the 15-year operating pro forma. AHP guidelines require that the rent paid by each household, exclusive of utilities, not exceed 30% of the targeted income for the unit. Indicate the total rent received and the amount of rental subsidy if applicable. The farthest column to the right shows if a unit passes or fails this 30% rent test. Next, we'll look at the sources and uses worksheet. Provide the project's total residential square footage, including hallways, common areas, and structured parking if these costs are included in the new construction or rehab costs. Only commercial areas of the building and commercial structured parking should be excluded from the square footage. Provide tax credit sales price if applicable. If the project will have tax credits, provide either the actual investor letter to substantiate the pricing or other third-party justification for the targeted pricing. Indicate construction type, either new construction or rehab, and also indicate the building type, apartments, condos, single-family homes, or townhomes. Input the project development costs in the uses of funds column. Certain non-cash costs are allowed in the uses of funds budget to align with LIHTC treatment, including donated land value, approved soft loan interest, and fee waivers. Documentation of purchase price acquisition costs must be provided and consistent with readiness and donation documentation. We are looking for final settlement statements or HUD-1's executed purchase or purchase option agreements. If the property owner, lessee, or sponsor acquires the project property from a party affiliated in any way with the property owner, lessee, sponsor, or other persons or entities involved in the project in a non-arm's length transaction, the bank will consider such acquisition to be a related party transaction. When evaluating related party transactions, the bank may consider any net cash gain from the transaction as excess sources of funds that will reduce the AHP subsidy requested, unless the gain is contributed to the project as owner equity, provided to the project as carryback financing, or used to retire existing debt on the property. For rehabilitation of existing affordable housing projects not involving the transfer of property, any acquisition costs reflected in the sources and uses worksheet will not be included in the total development costs for the purpose of determining the developer fee percentage. Capitalized reserves such as operating, replacement, transitional, social services cannot be paid for by AHP subsidy or by conventional financing. If capitalized partnership management, asset management, and/or investor service fee reserves are included in the budget, provide an explanation and third-party documentation justifying why the capitalized fees are required. Excessive and/or unnecessary reserves may indicate that the project does not demonstrate a need for the AHP subsidy. The bank, at its discretion, will determine whether the reserves are acceptable and appear necessary for project feasibility. Sources of funds. At the top of the worksheet, there are labeled and unlabeled columns for sources of funds. Indicate the name of the funding source. There are a limited number of columns available, and you cannot add other columns. The workaround, in case you need more columns, is to consolidate similar sources of funds with a breakdown on an attached document. For example, if you have a number of foundation grants, label one column as foundation grants, and on a separate document, provide a list of foundations and how much each foundation is providing. In each source of funds column, enter the dollar amount on the appropriate line of the cost that each source will cover. Be sure to indicate all financing details, hard, soft, rates, etc. Hard debt is defined as contractually obligated debt requiring repayment from project operating cash flow, excluding residual receipts payments. The spreadsheet fully amortizes all hard debt in most columns. However, you can use the last column to properly reflect interest-only payments or unconventional required payments. The worksheet automatically calculates debt service payments. Debt service payments are also auto-populated in the 15-year operating pro forma. To ensure consistent and reasonable rate assumptions, interest rates and spreads should be set in accordance with the interest rate assumptions guidelines included in the reference guide. If your loan is already committed, use the interest rate set by the lender and provide backup documentation. For required debt fees like California's MHP or other state programs in which there is a mandatory annual payment, you can now either enter it here as debt service in the last column if the project has other hard debt, or as an expense line item in the operating pro forma if the project doesn't have any other debt service. Documentation of approved sources of financing must be provided. Make sure the sources of financing figures reflected on the worksheet match the figures reflected in the submitted committed financing documentation. Discrepancies are a common occurrence and can result in a reduction in the amount of AHP requested. Note the total committed funds field. Please indicate whether the funds have been approved or not. Remember that the project must demonstrate a need for the entire amount of AHP funds requested. Next, we'll look at the Sources of Funds Summary worksheet. This worksheet collects required Federal Housing Finance Agency data. Please indicate which sources are applicable to the project. This is only relevant to permanent financing. Do not include construction and bridge financing. Include HUD, USDA, and VA financing under other federal housing programs. If a source does not fall clearly within the listed categories, please select Other. Next, we'll look at the 15-year operating pro forma worksheet. A project must be financially feasible for 15 years. Input income and expense assumptions. All costs except for the management fee, replacement reserves, mandatory debt fee payments, and debt service trend upward. All unshaded cells may be edited. Indicate whether the project is receiving project-based rental subsidy in the top right-hand corner. If the project is receiving rental subsidy, indicate whether it has been approved. If approved, include backup documentation in the Evidence of Rental Subsidy folder. As mentioned before, there is a separate line item expense for any mandatory debt fee payments, such as the 0.42% for California's MHP, AHSC, or VHHP programs. Use these if the project doesn't have other hard debt. Additional lines are included for other expenses. Provide details for these other expenses. Please do not use the words miscellaneous or etc. in your explanation. Indicate residual receipt payments on the appropriate lines provided. This is where you would include any partnership management fees or deferred developer fees paid from cash flow. Make sure that the amount input in the pro forma matches the figure entered on the Sources and Uses worksheet. Social services expenses are now allowed as an operating expense. However, we still have a specific line for them, so please use that so we can identify the amount and tie it to the empowerment budget. The project must have sufficient income to cover expenses. If not, it must have operating subsidy or a reserve to draw upon. Lastly, make sure to adjust debt service if loan payments change during the 15-year retention period. Next, we'll look at the 15-year commercial operating pro forma. If your project includes revenue-generating commercial space, you should fill out this worksheet. This worksheet allows us to assess whether the commercial space is financially feasible on its own. If your project has permanent debt and the perm loan has already been underwritten, indicate whether the lender included commercial income in their underwriting by answering the question at the top of the worksheet. Let us know what kind of commercial lease arrangement there is by selecting yes or no next to the triple net lease question at the top of the worksheet. If the commercial space is operating under a triple net lease, the commercial expenses will only be reflected in the commercial pro forma. If the commercial space is not a triple net lease arrangement, the commercial operating expenses entered in this pro forma will also be reflected in the 15-year operating pro forma. Enter all commercial income and the vacancy rate. Total effective commercial gross income will automatically populate in the residential 15-year operating pro forma based on what you include in this worksheet. Enter all commercial expenses in the lines provided. If hard debt was used to pay for commercial development costs, include the amount of debt service that the commercial portion of the building will carry. Next, we'll look at the workbook comments worksheet. We have added this worksheet to allow notes within the workbook related to the project's budgets instead of applicants using the supplementary application materials documentation folder to submit relevant explanations. Next, we'll look at the promotion of empowerment budget worksheet. This worksheet ties to the scoring of promotion of empowerment. No empowerment points will be awarded if this worksheet is not completed. Include sources of revenue that will be used to pay for resident services, and include all expenses related to those services. Revenue minus expenses should equal 0. Cash flow revenue in this worksheet should match the resident services operating expense in the 15-year operating pro forma. We'll now look at the benchmarks worksheet. The base information for the benchmarks worksheet will be auto-populated for you, except that you will need to manually compare your project's permanent debt interest rate with the benchmark for interest rate assumptions found in the reference guide. Please provide detailed explanations for all benchmark deviations. Some deviations may also be easily supported by documentation, for example, requirements of other funding sources. Deviation explanations no longer need to be quantifiable, but they do need to give us an adequate description of why the benchmark is exceeded so that we have enough information to explain how we got comfortable with the deviation. For example, If your project exceeds the construction cost per square foot benchmark, you might provide a detailed explanation from the project sponsor, which explains that the overage is related to special soils work based on the project site conditions, as well as prevailing wages, premiums on labor costs. If it were not for these extraordinary costs that are not present on an average development, the project would otherwise be within the benchmark. As noted earlier, the construction cost per square foot calculation includes site work. However, environmental remediation and hard cost contingency are not included. Remember that this means that you cannot use environmental remediation or hard cost contingency as part of your explanation for the deviation. For this benchmark, the bank may use its own portfolio and other construction cost data in addition to RS means estimates in determining reasonable costs. Exceptions to the developer fee benchmark will be reviewed on a case-by-case basis. This benchmark is 15% of total residential development costs without developer fee and capitalized reserves included in this total cost calculation. Projects that exceed the 15% limit will have to provide reasonable explanations and support documentation for any deviation to the developer fee benchmark. Note that for us to consider a developer fee benchmark deviation acceptable, there must be an equity contribution back to the project that offsets the overage. We cannot accept deferred developer fee or a sponsor loan as a contribution, which is different than other funders. If the developer fee increases to be above the benchmark at disbursement or initial monitoring, repayment of the overage or a reduction in the AHP subsidy may be required. The management fee benchmarks are calculated differently depending on the project's location. This calculation will happen automatically. The operating cost per unit per year benchmark limit is also variable based on the location. In the San Francisco Bay Area, SF Bay Area, and Los Angeles metro area, LA Metro, the limit is between $5,000 and $10,000 per unit per year. SF Bay Area includes the following 9 counties: San Francisco, Solano, Alameda, Napa, Sonoma, Marin, Contra Costa, San Mateo, and Santa Clara. LA Metro includes the following 5 counties: Los Angeles, Ventura, Orange, Riverside, and San Bernardino. All other locations in California, Nevada, and Arizona are between $4,000 and $8,000. Partnership management and asset management fees should be shown as residual receipts unless otherwise documented. We'll now look at the targeting self-score worksheet. No additional points are given for units targeted below 50% AMI. To score the project's targeting, AMI targets above 50% must be entered. Next, we'll look at the AHP application comparison. This worksheet is intended to help you maintain consistency between data in the application and data in the financial workbooks. When you have finished filling out both documents, click the Run Comparison Now button to identify any inconsistencies. If any errors are noted, fix them and run the comparison again to make sure the issue is resolved. That concludes the need for subsidy and project feasibility review segment of the presentation. The application package is on our website. The form to register for the Secure Portal access is also on our website. You can register for an application workspace on the Secure Portal right now in anticipation of applying. If you have any additional questions beyond what is covered here or answered during the Q&A session, please contact one of us and we will be happy to help you get your questions answered. Note that there are 2 sets of contacts, one for setting up your Secure Portal workspace and 3 contacts for questions about the AHP application scoring and feasibility. Now we will go to the Q&A session.